Quality Rule Sets 12 and 13. This program is brought to you by XBRL US and by the Data Quality Committee and by the Center for Data Quality. The members of the Center for Data Quality, you can see their logos on our screen right here in front of you. And I wanted to mention that Topan Merrill is the founding member of the Center for Data Quality, and we're going to be led today by Joan Berg from Topan Merrill. I want to just address a couple of logistical issues as we go through the program. We are offering CPE credit today. And so for those of you who have asked to receive CPE or would like to, but even haven't asked yet, if you respond to the poll questions that we'll be taking at 2 different points during the session today, we'll make sure that you get your certificate. We are also, I also want to mention that if you have any kind of technical difficulties, please email us at support@xbrl.us and we'll do our best to get you back up and online. Also throughout the program, we can take questions at various points. So if you do have questions, just put them into the Q&A link that you see at the top of your screen, and you'll be able to submit a question and we'll respond to those. So with that, I'm going to go to our next slide here and just explain the session for today. We're going to start off just telling you a little bit about the Center for Data Quality and the Data Quality Committee. Joan Berg is going to lead us with that. Joan, as I mentioned, is the chair of the Data Quality Committee and the director of XBRL Services at Topan Merrill. Joan is then going to lead us through an analysis of error trends that I think are pretty interesting and shed some light on problems that issuers are having and how the data quality rules have been instrumental in helping to bring those errors down. We'll then cover a couple of CPE questions, and then Campbell Pride, who is president and CEO of XBRL US, is going to address the 13th DQC rule set. So these are the rules that are currently out for public review. He's also going to briefly touch on the 12th rule set, which has been finalized. And all of these rules, both the approved and the proposed rules, are available on our website and able for any issuer to use. Finally, we'll cover CPE questions and then some upcoming events and other programs brought to you by XBRL US. So with that, I'm going to turn it over to Joan. Okay, and Joan, you may be on mute, but we're not hearing you right now.
Thank you. Thanks, Michelle. The XBRL US Center for Data Quality is a collaboration of public companies, service providers, and data users, whose mission is to address the public's concern about the quality and usability of XBRL financial data. Our focus, next slide please, is on identifying issues that impact data quality and that also impair the ability to consume and analyze XBRL data. Based on input from users, we develop guidance and rules that can be accessed free of charge by all users at XBRL US's website. We are committed to issuing rule sets 3 times per year. This year, we had public exposure of, well, we will have public exposure of 3 separate rule sets, one of which, the first one, has already been approved and will become effective in September. The second one is under public exposure right now, and then we'll issue a 3rd set later on in November. We also provide input to representatives of the Securities Exchange Commission and Financial Accounting Standards Board regarding any issues that we identify in our work. This slide identifies the names of the members of the XBRL US Data Quality Committee. You can see that it includes data and tool providers, analysts, preparers, and standard setters. In addition to the groups listed here, members of the Center for Data Quality are actively involved in a subgroup that suggests topics for consideration and shapes the rules as they are developed. Those participants were shown on the first slide in this presentation, and they consist of the members of the center. I'm going to talk today about the impact the data quality rules have had on improving the overall quality of XBRL data. First, I want to show you how you can find these results yourself. If you go to the XBRL website, enter the Data Quality tab, you can see that there are separate entry points for various topics. On the far left is the Rules entry point, where you can access details about approved rules and topical guidance issued by the committee. We've issued, I think, topical guidance on 4 topics. The second entry point shows the software providers that are certified by XBRL US to run the data quality rules within their software. And then I've highlighted the entry point that we're going to talk more about, which takes you to a screen that allows anyone to run the rules for free using the XBRL US application. And if we go to the next slide, if we actually click on that entry point, it'll take you to this slide. And on the far right, the first line in red, it says check your filing with data quality rules. That's how you can actually run the rules yourself. But we're going to drill down on the third button, which is the aggregated real-time filing errors. This brings us to graphical representations of the errors that are found. Now I've switched that to an Excel worksheet here, and I've listed some of the first rules that were developed by the committee. We're going to drill down on the 2 that are highlighted in yellow, DQC 1 and 15. Both of these had about 17,000 errors when the rules were first approved in 2016 and 2015, respectively. They show a dramatic reduction in errors since they were approved. In fact, for all the rules shown on this slide, there is a reduction in error with one exception. I highlighted DQC 005 because the results there reflect an anomaly with a significant increase in the most recent quarter. We did investigate this and noted that most of these errors resulted from a new entrant into the market of software providers. So we will be reaching out to that company to explain to them the benefits of running all of their filings through our rules. On the next slide, we see that even our most recently approved rules show improvement. So the rules that were approved in October became effective January 1. And you can see that in the period since they were approved, they've gone down dramatically. And then the last 5 rules are the rules that Campbell's going to be talking about a little later in this presentation. Those were approved in February, and they're currently in the public review process. So in the first quarter of the year, that's the period that they were approved. The numbers are identical to the second column. But you can see the number of filers that are running these rules through on a preliminary basis in the public exposure period. Even that impact has brought down the error rate quite significantly. The next slide. Let's look at some of the details. This is DQC 15. It's a rule which identifies elements which should never have a negative value. We've made some exceptions to the rule. For example, values that are contained in the eliminations member of a consolidation can be negative. And the rule is updated annually for new elements added in each taxonomy. So version 12 of the rules added 145 elements from the 2020 taxonomy that should never be negative. On this slide, I've highlighted Q1 and Q2 of each of 2019 and 2020. The appropriate comparison is sometimes to look at the difference between the same quarter of each calendar year because of the increase in errors that may result from the larger number of values contained in the first quarter due to the sizable number of 10K filings that occur in that period. Still, looking at the comparison from Q2 of 2019, when there were 4,649 reported errors with this rule, we see a significant improvement to Q2 of 2020, which had only 3,497 errors. On the next slide, we see that most of the errors are made by very few companies. So this slide was prepared based on Q1 filings, and there was one filer that had 176 errors. And then it quickly dropped off. There were 27 companies that had about 20 errors. And as you can see, it drops off after that, so that those remaining companies had 2 to 5 errors, very insignificant numbers relatively. So on the next slide, I show what a typical error is, and that is not changing the sign from the presentation format. So in the presentation format on this example, options exercise is presented as a bracketed number. However, the definition of the element indicates it's the number of options exercised. So it needs to be entered as a positive number and the label negated. When we look at the top 10 errors that occurred for DQC 15, we see that the most frequent error is the use of the element interest expense with a negative value entered. When we looked these up, many of these errors are due to presentation errors, as I discussed on the last slide. They were simply presented in brackets. But most of the errors are due to using the wrong element. In the case of interest expense, when we looked at the actual filings, the label often read interest expense, net. And so it's more appropriate to select an element that reflects the netting of interest income and interest expense. These filers should consider using the element that I've shown in red on this slide. As we look at the other elements on this slide, we can see that they are typically the same issue of bracketed amounts being entered incorrectly. We did identify one item that had 36 errors reported, and that's on the second to the last row. That line normally is entered as a positive number, but we did find some filers had correctly used this element and they had reinsurance that exceeded their claims liability. Because the element itself had provided for a netting, we removed this element from the rule in version 12. I mention this to you so you know that we are looking at this data and encourage you to contact either Campbell or your service provider if you feel that any of the rules are in error. Now let's look at the next slide, which has the data for Q2 of 2020. In this case, we are seeing some changes in rankings from Q1. The top element for errors continues to be the misuse of the element for interest expense instead of the element for interest expense net of interest income. All of the elements in bold were on the list in Q1, but we do see some new elements. We investigated these errors and believe they are mostly due to incorrect element selection. So when filers see an error under DQC 15, they should first see if they have entered that value correctly and not just the way it is presented in the filing. If that's not the cause of the error, you should investigate if a different concept is being disclosed or if an extension is required. This rule, DQC 15, was incorporated in the 2020 Data Quality Committee taxonomy issued by the FASB and approved by the SEC in March of this year. If you are filing in the 2020 taxonomy, you may have received SEC warnings for these errors. DQC 1 identifies when inappropriate members are used on an axis. There are some axes for which only members shown on that axis in the standard taxonomy can be used. The range axis is one example. There are other axes which should always have extension members. So for example, the plan name axis, which is used for share-based compensation arrangements, is expecting to get an extension member on it. DQC 1, which is also included in the taxonomy rules approved by the SEC, identifies appropriate restrictions on the members used for 27 different axes in the taxonomy. And we are very pleased at the significant reduction of errors year over year and quarters that chart showed. This slide shows the top errors that occurred in the first quarter of 2020. The biggest error, over 1,000 values using the axis incorrectly, was attributable to misuse of the legal entity axis. Now, there were only 21 filers that had this error, but they must not have noticed that the parent company member was moved to the consolidated entities axis in the 2018 taxonomy. so it is no longer permitted to be used on the legal entity axis. Filers should follow the guidance issued by the FASB regarding how to report values of a consolidated entity. Another common error, the second one here, is the use of the equity components axis to differentiate classes of stock. When there are two classes of preferred stock, such as preferred A and preferred B, the filer should use the preferred stock member on the equity components axis and also use the class of stock axis to differentiate preferred A and preferred B. Two axes need to be used. Let me quickly go through the rest of these errors. The range axis was renamed and moved to the SRT taxonomy in 2019. It now has a standard label of statistical measurement axis and can only have the minimum, maximum, weighted average, median, and arithmetic average members on it. It cannot have earliest and latest or other extension members. The fair value hierarchy axis is only intended to be used for the various levels defined in the fair value hierarchy. Some filers combine levels in their disclosure when the values are immaterial, so we have created standard extensions. For example, fair value inputs level 1 and level 2 member to accommodate that situation. We encourage filers to use these suggested standard extensions in order to improve the ability to consume the data. It is not appropriate to move members from other axes onto this axis. The consolidation items axis is primarily restricted to the members identified in the standard taxonomy. Like the fair value hierarchy axis, however, we have identified situations where combinations of those members are needed. And so we have specified standard extensions which should be used. For example, corporate and eliminations member, if those two categories are combined. We also have provided guidance that if other combinations are identified, they can be nested in a parent-child relationship with the members that have been approved. The issues with the measurement basis axis are similar to those with the fair value hierarchy axis. Companies are switching members between these two axes, and it produces an incomprehensible meaning when the data is analyzed. I'm going to skip over the business acquisition axis because that was just added in version 11, and it's not effective, was not effective in Q1. The currency axis is peculiar in that the members that are on that axis are located in the SEC's currency taxonomy. So we feel that the companies that had these errors created custom members for currencies, such as Mexican peso, rather than use the standard elements that are in the in the currency taxonomy. The subsequent events axis, there's only one member permitted, and that's the subsequent events member. The rest of that tagging for subsequent events should mirror how that disclosure will be tagged in the period after which it is a subsequent event. So if it's a debt disclosure, use the long-term debt axis and all the modeling that you're going to use in the subsequent period, and just put the subsequent event member on top of that. There's only one member allowed on that axis. And finally, the errors on the scenario axis are all over the place. We find people taking members from any axis they want in the taxonomy and putting it here. That's not appropriate. And so extensions are permitted on this axis, as well as the members that are located on this axis in the standard taxonomy. Notice that for all of these errors, the number of filers making the errors is relatively small. However, every numeric value that is included in an inappropriate member axis combination counts as one error. So the numbers become quite large in total. The message is to pay attention to match the members with the axis for tagging values. Now let's talk about Q2. The second quarter basically saw a repeat of the types of errors we saw in Q1. You will see that the legal entity axis fell out of first place, with only 11 filers making that error, down from 21 in Q1. The entity components axis, however, continues to reflect a misunderstanding of the proper tagging when two classes of stock exist. There's only one new axis on here that we saw, and it was only made by two filers. It's the second to the last line, and that's the position axis. This is intended to reflect if the company is in a long or short position with its hedging program. And the example that I found of a company who had used this axis incorrectly, they had created an end of period member and put that on the position axis. That's not appropriate. So hopefully this quick review has identified common errors detected by running the DQC rules and how to correct them. We look forward to a continued decrease in the number of errors on these two important rules. And now we are going to break for some CPE questions.
Joan, thanks very much. And as I right before I pull up the poll questions, we did get a question from the audience that I thought would be good to address now is, where can users find the DQC suggested standard extensions that you mentioned?
Michelle, are you able to scroll back to, I think it's slide 6 or 7.
One sec.
That one. So if you look under rules and guidance on the far left, if you were to drill down on that entry point, there is each of the rules is listed there. And it gives some of those on the list of, so for the standard extensions for the members, way down in the rule for DQC1, in red lettering, it'll say list of axes, and there's an Excel worksheet that you can pull up, and that will show you what all the standard extensions are that have been approved by the committee.
Great, thank you.
And just in addition to that, there is also the FASB has also published a taxonomy which highlights that as well. And they have a DQC rules taxonomy with, if you look at that on the Yeti viewer they have, you can bring that up and you can bring up DQC1, and it also explains all those extensions.
Thanks, Campbell. Okay, so I think we're gonna move on to the CPE questions, and just bear with me a second here. Okay, so for those of you who are getting CPE credit, please make sure that you respond to this. And again, if you forgot to specify that you want a CPE credit, please go ahead and answer the questions, because we can still get it to you if it's something of interest. So I'm going to go ahead and launch the polling for our first question. And please let me know if this is for some reason cannot be seen. The questions that we have here are, which of the following best reflects the composition of the members of the Data Quality Committee? Is it number 1, filing agent, preparers, data and tool providers, analysts, and standard setters? Or is it option number 2, filing agents, data and tool providers, and standard setters? Or option 3, filing agents and standard setters? So I'm going to take another 30 seconds or so to give everybody a chance to respond. And just about another 5 seconds and we'll close the polling. Okay, I'm going to end the polling right now. Okay, and I also want to mention that some people have asked about, what are the answers? And the answer to this question, which of the following best reflects the composition, is number 1. It's filing agents, preparers, data and tool providers, analysts, and standard setters are on the committee, either as regular members or observers. So we're pleased to have everybody. So let me go on to poll number 2 and launch this one. Which of the following is the most common DQC error? Is it positive value errors? Is it axes with inappropriate members? Or is it durational aggregation? So you just click on the appropriate button, and we'll take about another 30 seconds here. Okay, just about another 15 seconds and I'll be closing down the poll. Okay, I'm going to be shutting down the polling here. All right, and the answer, which most people did get correct, was axes with inappropriate members. That is one of the most common errors. So with that, I'm going to stop the polling for now. And we're going to move on to our next part of the program today, which is covering the rule sets. And we'll start with 12, and I'm going to turn it over to Campbell Pride.
Thanks, Michelle. So rule set 12, which has been approved, and a number of these rules are going to start becoming effective over the next month or two. So just to give just a quick recap on what's going into effect here. We added some rules to pick up percentage items. The first rule really just covers where companies have been entering a percentage incorrectly. So typically, if you've got something like 23%, the value in XBRL would be entered as 0.23. However, they're being entered as a whole integer, like for example, 23. So this just picks up those cases where we've got percentage items that people would use just to pick up those errors, so that when they think they're reporting as 23%, they're not reporting it as 2,300%. There are a number of rules that are also added for IFRS non-positive items. So this is really detecting items that we would expect to have a negative value. And this is typically things like an intercompany elimination. We expect those to be negative. However, a number of companies have been reporting them as positive. So this rule just helps you prevent that rule specifically for IFRS filings. The next rule, DQC 93, also applies to IFRS. This reflects another rule that we already have for US GAAP filers. And what this rule does, and some of you may have seen this, if you're a US GAAP filer, it just checks that if you've used an element and then you've reported it for example, first quarter and the second quarter, but you also report the value for the first half of the year, for example, something like cash flow, then what this rule does is just make sure that the values it adds the values across periods and makes sure that they actually match to the total. And this rule actually, there's a lot of cases companies may have used an element in one file in one part of the disclosure, and then they use that same element in another part of the disclosure, but they're slightly different, so they don't add across time. So this rule picks up this. With inline filings, there were a few issues in inline filings where in some cases you can report the values with different scales. So this rule is also adjusted. So if you report a value multiple times in a filing with different scales, this rule takes that into account as well. The US maturity schedules was added, and just to make sure everyone's aware of this, the FASB had made a number of changes to all the maturity schedules in the 2020 taxonomy. So if you're using these to report anything which is due in year 1, year 2, year 3, year 4, and then the remainder and then a total. So if this rule will apply for pretty much for quarterly filings, and it really just clarifies if you've got the remainder for the financial period, how that should be tagged. The definition of those was changed by the FASB. So this rule just basically helps to make sure that companies are getting that right when they make these changes. In some cases, for quarterly filings, you may need to use a different element than you have in the past. And then the final rule was just on common stock outstanding. This can be reported in two places. There's actually two elements for this. So this rule just checks that these two are consistent. One's for the DEI, and the other is in the US GAAP taxonomy. In some cases, companies had reported you would have different values in these two places. One would be reported at the time of filing, and one would report at the end of the year. So this rule just checks that you haven't made a scale issue on one of those. This seems to be the area where the scale problems seem to come up. typically because companies will report it to the exact share and they leave the scale on, so it has caused some issues in some cases. So this rule is picking that up. So these rules, you can run these today if you go to our website, and most of the filers are adopting them. And so you can should see these additional rules start coming up if you're running the rules. Okay, if we go to the next slide, please, Michelle. All right, so we've added 3 new rules in rule set 13, and the first rule here is a rule that we'd worked on with conjunction with the FASB. They had done a review of revenue recognition, and they noticed some problems, so they had asked us to add a rule for one particular case that they had identified, and this is there is an element of the taxonomy for the contract with customer liability, and this is a liability that you would have on your balance sheet, and then there's another disclosure where you report how much of that liability at the start of the year was recognized into revenue. So in theory, the amount that you recognize into revenue can't be greater than what that liability was. So this rule just checks that, and I think there'd been some misunderstanding around what this element had meant. So that was just like how much had we moved out of the liability and into revenue during the period, irrespective of what the opening balance was. But the FASB disclosure is quite clear on what this means. So this rule has been put in and will is already picking up a couple of hundred companies who've made mistakes around doing this. So this is in public review at the moment. You can run the public review rules on your filing if you want to. But these rules are probably coming into effect. The public review is currently running. So if you've got some concerns about this, you can certainly add a comment, or if you think we should be doing something different, that would be good. The rule covers both where you've got 2 cases where you just report the liability classified. So if you got a split between non-current and current, it adds them together. And the other case where if you have it unclassified, if you just report the total liability, it checks both of those. So that's that rule. The second rule we have is this just gives an example of it. You can see here the beginning balance where we've got 8564. And then they've got the amounts, revenue recognized over time, delivered in time. These amounts should be recognized. Those amounts should be coming out of the beginning of the period balance. All right, so we go to the next slide, Michelle. So the next rule we have here is financial statements with no associated calculation. So this rule is pretty all-encompassing, and it's detecting lots of issues in filings. And what it's detecting is where there's a calculation relationship missing, either on the balance sheet, on the income statement, or on the cash flow statement. And the way that this rule works, it basically goes and looks at your financial statement, and it basically says, okay, you've reported all these items, for example, in your balance sheet. So we would expect that there is an associated calculation with each of those items. And then the rule checks that those calculations are included in the filing. And if they're all there, then that's fine. But if there's calculations missing, then it's gonna report those. So there are numbers obviously on the balance sheet that you won't have a calculation for example. And so it does exclude some of those, like the parenthetical items obviously get excluded. It only tests, as I mentioned earlier, the balance sheet, the income statement, and the cash flow statement. So that's all it's looking at. It's not looking at the notes or anything like that. In the cash flow statement, there are disclosures that you make on the cash flow statement, for example, which are not included in the calculation. That's typically going to be the supplemental information. So the rule excludes anything from the cash flow statement that's included in the supplemental cash flow information that you include there. It also excludes any other information which may include the non-cash transaction amount or cash disclosures that shouldn't be included. So this rule, I think since the start of the year, has identified like 4,000 missing calculations. We went back and looked at that. It also identifies if you're missing you know, in some cases, companies have excluded their calculation link bases altogether, so it's going to pick up those as well. And most of the cases it picks up is you may be rolling forward from a prior period, but you've added a new element and you put it into the taxonomy, but you forgot to put the company forgot to put the calculation in. So it's picking up those as well. So this is currently in public review. You should try and run this on your filing and have a look at it. And if you've got any concerns, if you're thinking it's returning a false positive, please let us know, because we want to then we can just make sure we exclude that condition from the rule. This slide here just gives an example of it. You can see here's a company. They've reported profit loss on the left-hand side, which they call net loss, in their statement of operations, and then the box which says net loss in the middle of the screen. You can see net losses there in the presentation, but typically we should also have a calculation in it. So that net loss is not appearing in the calculation, but it's obviously the profit loss should be being calculated as part of your income statement. The item above, total other expenses, however, in the next box across on the right top side, you can see is included in the presentation parent-child tree, but it's also included in the calculation summation item. So that item has been included there. So this one filing, they just had excluded profit loss for some reason from the calculation. So this rule will pick that up and basically say, look, the profit loss is not there. You need to add this into your calculations that you've defined. So this rule, as I mentioned, is pretty comprehensive. It covers all three financial statements to the extent that it, and basically like looking at those and identifying them. It doesn't include the statement of shareholders' equity. If you combine the other comprehensive income with the income statement, it's going to pick up those as well. So just to be aware of that. So it's going to be quite useful if you want to check that if you are missing a calculation, this rule will actually check that for you. Right, can we get the next slide? Okay, so the final rule, this is kind of minor and no one's had any errors for this yet, but we added this rule. This is just more of a guardrail type rule. This element was included this consolidation axes, I think it's called investments by consolidated and non-consolidated entities axes. And this rule was originally added in the this axes was originally added in the 2020 taxonomy. And we thought it was going to be needed for some of the disclosures that around the disclosure of, what was it for variable interest entities. However, there was a different alternative was used in the end, and so this axis was no longer required. So to stop, it's going to be removed in the 2021 taxonomy. So to eliminate this, people accidentally tagging it, we've just added a rule that says if you've used this axis, don't use it, and then you should be using probably another axis, probably the consolidated entities axis. Anyway, so this rule is there and that'll pick it up. So if you see this, that's what it means. It just means don't use this axis. It's going to be deprecated and it probably shouldn't have been used in the first place. So those are the proposed rules. You can go to the next slide now. And this is just an example of the message here where someone's using it. This is just made up because no one's obviously used it yet. So you can see it just basically tells you that the axis has been used and it shouldn't have been used.
Great, thank you, Campbell. And before we go to CPE questions, we do have a few questions coming in from the audience. The first question is, what is the effective date for the rule set 12?
Off the top of my head, I'm trying to remember what it is. It is. Do you remember what it is, Joan?
Yes, I'm sorry, September 1.
Thank you.
Great, thank you. And the second question is related to the public review rule set 13. How long is the public review? And what kinds of questions or what kinds of comments are you looking for in the review?
So usually the public review is 45 days. What we would like people to do is to run, if you're a filer, is to run your filing and see if there's any impact on your filing. And if there is an impact, you may want to look at it and say, is this really valid? purpose of the public review is we want to make sure these rules are as accurate as possible. We go out of our way to make sure that we're not getting false positives. So if there's something in there that you think is incorrect, then we can adjust the rule. Also look at the message of those. If the message isn't clear and you think we can clarify what the meaning is, we really want feedback on that as well. And if you think we're missing something, if you're something we should be checking as part of the rule, then please include that as well.
Great, thank you. And another question is related to the analysis, and I think this question is for you, Joan. Is how frequently does the DQC conduct this kind of analysis? And is it possible to have access to the data that supports the analysis?
You mean in terms of drilling down and seeing which companies are creating?
Well, I think, yeah, I'm not sure exactly, but I think the question is, can some of this data be made publicly available so that others can see, more deeply how what kinds of errors are popping up and what are the most common issues?
So they're on XBRL US's website. There are two things you can look at. So where I showed you in those graphs, as you enter that entry point, there's graphical data that's for the aggregated data. There's graphs for most of the rules. The rules that don't have graphs tend to have errors under 200, not too many. Periodically, so you asked how frequently we look at them. We just really started to, well, we've always looked at them a little bit, but we've started to look at them in a more structured fashion over the last like 3 quarters. So we are taking time to
I'm actually going to go to that section of our website just to show people as you're describing it, okay?
Yeah, that's a good idea. So in addition to being able to look at the graphs, you can also see you can look up filers and see what errors they're making. And we'll show that too, maybe.
So should I go to the aggregated real-time filing errors?
Yeah, yeah.
Yeah, we can't see your screen now.
Oh, you can't, okay, I'm sorry. Let me stop sharing and start sharing the whole screen again. Sorry about that.
So if you scroll down there, they come up kind of slowly, but there's going to be graphs. See how these graphs come up? So there's like, I don't know, maybe 20, 25 graphs here. So that's where you can see it on an aggregated basis.
And you're pulling real time, right, Joan? Which is why it's taking a long time.
Right. Well, it doesn't take a real long time, but if you, at the bottom lower right of each of those graphs, you can press on Google Docs or whatever it says there, and it blows it up into a big thing. Don't do that, Michelle. Oh, well, too late.
Because it takes a long time. Okay, we're just
no, it doesn't. Okay, but so then go back up to the top.
Mm-hmm.
And it says on the far right under aggregated real-time filing errors, it says check your filing with data quality rules. See that in red?
Mm-hmm.
And then scroll down. So this is that box that you just scrolled past is where you can check the rules. But oops, go back up, sorry. Are you logged in?
Yeah, I think you wanted to go to let me go back to here again.
No, I want to go here where it says, oops, you were in the right place. So in the narrative where it says, yep, that's what I wanted to show you. Mm-hmm. So here we can see by company how many errors they are. And this takes a little time to populate. So at first when we looked at it, New Asia Holdings said 0, but now it says 9. And if you clicked on that arrow on the right, we would see what errors they had. And you click again on the arrow and it gives you further description. So this is, if you were actually to run the rules on XBRL US's website, this is going to show you, it's going to give you a little message that usually tells you, gets you started on how to fix the error yourself.
Right. So what you're seeing here is these are for already submitted filings. So these are filings that have been submitted and accepted by the SEC, and these
Right.
they're getting. But for those of you who have filings that have not yet been submitted, it's a really good opportunity to use the check your own filing, which is this other check your filing with data quality rules, and you can check both the approved and the proposed rules, and that'll let you see kind of what your errors are before they go in, so you have an opportunity to fix them.
And just a note on that, most filing agents and filing software, they will typically validate these rules before they file with the SEC anyway. So if you have a filing agent, whoever you're using, they should be running these rules. And I think the vast majority are. There's only a couple that are not. Or alternatively, if you're just using software, most software at this point is supporting these rules. So if your software vendor doesn't support it, you should ask them, are you supporting the DQC rules? And just to check. And if you're not aware where it is, you may want to ask whoever provides your software how you can run them within that software as well. And if you can't run it through the software, then you can run it against our website. Or alternatively, there is software that we have on our website which you can download and you can run locally if you feel more comfortable with that.
Okay, great, thank you. I think those are all the questions that we have so far. I'm going to go back to our slides and just go to the CPE questions. And we're going to take our last two polls. And David and Campbell, if you can let me know if for some reason a poll is not showing up, because I did get a text from someone saying that. Okay, I'm launching the poll for...
Yeah, we see it.
You do see, okay, great. Okay, so the question here is, one of the new DQC rules in Rule Set 13 is designed to catch errors identified with liability revenue recognized. Which of the following best captures the mistake that it's designed to identify? Okay, so is it identifying situations where the element contract with customer liability revenue recognized is less than the value for contract with customer liability? That's option number one. For situations where contract with customer liability revenue recognized is equal to contract with customer liability, or situations where contract with customer liability revenue recognized is greater than the value for contract with customer liability. And just about another 10 seconds on this response. And I think I know the answer to this one, but Campbell, correct me if I'm wrong on this when we close this out. Okay, I'm going to close it out now. And I believe the answer is that it should be greater than the value for contract with customer liability, which I believe is what most people did respond. Okay, and our last poll question. Okay. Which of the following newly proposed DQC rules in Rule Set 13 is most likely to have the biggest impact? Is it liability revenue recognized? Is it financial statements with no associated calculation? Or is it invalid consolidation axis? Which is really the most important, the important of the three rules that you want to make sure that you take care of. So just about another 30 seconds here. Okay, I'm going to close down the poll now. And the correct answer was number 2, financial statements with no associated calculation. So thanks everybody for responding to those questions. I want to thank Joan Berg from Topan Merrill for leading the discussion today and conducting the analysis, which was great and really helpful, and also Camel Pride, who walked us through the new rule sets. And I encourage everybody to participate by getting into the public review, taking a look at the rules, running your own filings, either past filings or current filings, and checking to see, you know, how they perform against the proposed rules, and telling us what you think. And now, before we sign off for today, I just want to mention a few other programs that XBRL US has. I wanted to mention SEC filer membership. I know that many of you on the call today are SEC filers, and it's a kind of unique category of membership for XBRL US. Many of our members are large corporations. We have some individual members, but we have a special corporate membership for SEC filers that carries with it a number of key benefits that we think are really helpful for filers. One is an added rule layer. You know, most of you today are using the DQC rules, which is obviously really critical. That provides a base level of consistency with working with the US GAAP taxonomy and base level of quality. This added rule set available through SEC filer membership checks things like conformance with US GAAP, reasonableness, calculations, and other types of validation. It also allows SEC filer members to participate in important working groups. We have a number of working groups, including the Data Quality Committee, that SEC filer members can participate in. And another one that we recently launched is a regulatory modernization working group that focuses on developing closer communication with regulators like the SEC, standard setters like the FASB, to make sure that they understand issues that filers and the vendors that they work with have to deal with every day, with things like the Edgar system or implementing new rules. So that's a group that our SEC filer membership is welcome to participate in. Also support and answers to questions. I know there's lots of questions out there from SEC filers about, you know, developing their company extension taxonomy, about making sure they have the latest guidance from various regulators and standards organizations. Being part of our membership, you know, can help you get answers to those questions. Also, access to real-time corporate data. We have a number of tools that our SEC filer members can use, including access to our database through screening and querying and extraction tools that we have. We also have taxonomy comparison tools, so that when a new release of the US GAAP taxonomy is available, you can actually you know, compare your own existing filing against the changes, so you can identify what's been deprecated, what needs to be changed, for definition changes that will impact you. And then finally, recognition through a program that we have called XBRL Achievements, recognitions for community contributions, professional development, and use of data. So if you're interested in SEC filer membership, you can contact me directly or any of us here, or just contact info@xbrl.us. The other thing I want to mention are a couple of events that we have coming up. We have a webinar on September 16th, which is focused a little bit more on people developing taxonomies than on SEC filers, but it still might be of interest to people. It's on machine readable data available through the single data model. And we're going to be featuring a gentleman from the FDIC who's going to talk about the taxonomy that they've developed and how they've been able to work with XBRL. And then last, we have our XBRL US Investor Forum, which we're calling Ready for Anything, Using Data in Perilous Times. That is scheduled for November 18th. It was originally intended to be an in-person session. We're probably going to be switching that to an online program. And so we hope to get a lot of SEC filers and other organizations to participate, because I think it's going to be great. We have an SEC commissioner who's giving a keynote address. We have a vice chair from PwC also giving a keynote address. So I think it should be a really interesting session. So with that, I want to thank everybody for joining us today. And thanks again to our speakers, to Joan Burke from Topan Merrill and Campbell Pride. And we hope to see you in September at our next event and at other programs that we have going forward. Thanks very much.